Okay, so let's talk about why we have audits, and then I'll just kind of cover the CPA profession in general. And obviously you can tell from the title of this slide is that it's in the public's interest. So one thing I want to clarify here is obviously auditors perform audits of publicly held companies as well as privately held companies. But our main focus will be on audits of publicly held companies. So, and for the most part, the audits are very similar. It's just that for publicly held companies, the PCAOB have standards that the auditors have to follow with respect to publicly held companies. Same thing, SEC have standards or requirements that the auditor must adhere to when they audit publicly held companies. So for the most part, the audits are very similar. I will identify where there would be a divergence for a publicly held company versus a privately held company. But for the most part, I'm approaching the discussion of audits from the public perspective, because that is really the more riskier audit. So the Center for Audit Quality has, and I don't know, let's see if I can. So the Center for Audit Quality is was started actually as in response to and kind of grew out of the fact when we were having all these audit failures, and there's a concern from the public about the quality of audits and the auditor, whether or not the auditor is actually performing audits in the public's interest. And so the Center for Audit Quality consists of members from the academic community, from all of the major, from all accounting firms, representatives from accounting firms, as well as regulators, PCAOB members, SEC, and they're really looking at improving the transparency of the audit process, as well as the quality of audits. And so this is a website which is really useful, but one thing that I wanted to, so let's just take a quick, it's just a quick 4-minute video.
Public companies, the ones traded on the stock exchanges, have to put financial statements showing how they did the year before. Here's how it works. The companies prepare their financial statements. Then I come in, ledger lines, independent external.
All right, I'm not sure.
Auditor, Johnny Law, to check the numbers and those financial statements and issue an opinion in writing. It's independent, the chair of the company's audit committee. It's go time.
The Audit Committee is an independent group of the company's board of directors. We're responsible for hiring the external auditor to perform the audit in accordance with professional standards, which include being skeptical and objective. We're also responsible for providing independent oversight of the company's financial reporting and internal controls. And man, Ledger is one.
Do you know why we might not have any sound on this? It should be. This is at the top. Okay, let me try it again. Let's see.
Showing how they did the year before. Here's how it works. The companies prepare their financial statements. Then I come in, ledger lines, independent external auditor. Johnny Law at the SEC says I gotta check the numbers and those financial statements and issue an opinion in writing. It's independent, the chair of the company's audit committee. It's go time.
The Audit Committee is an independent group of the company's board of directors. We're responsible for hiring the external auditor to perform the audit in accordance with professional standards, which include being skeptical and objective. We're also responsible for providing independent oversight of the company's financial reporting and internal controls. And man, Ledger is one skeptical guy.
On the U.S. stock exchange, money's like cheap liquor at happy hour. If I have a concern about how the company is reporting its numbers, I discuss it with these guys. After all, they have the final say on how the company is delivered by companies to their investors. You want on the audit team? But if a company wants, my team is a mix of CPAs and other professionals who have the right skills and knowledge for the job.
I'm not sure what's going on with the sound, so.
Our work includes what they call a risk assessment. For a company, risk can.
All right, but this is posted, I'll post this on the Blackboard, but I strongly suggest to just take a look. They're like 4 or 5 minute videos. There are 3 of them that I think is pretty informative to just give you an overview of what the auditor's responsibilities are toward the public. So I talked a little bit about, auditing and accounting. And so you know what accounting is, right? We use financial statements. We use generally accepted accounting principles as a framework in which companies record and classify and summarize the transactions that they engage in. So they summarize, we sold goods to a customer, so we record those goods in our income statement, we record that sale in our income statement, and we record the accounts receivable in our balance sheet, right? So debit, accounts receivable, credit revenue. So when we sell to customers, we pay employees, debit cash, debit payroll expense, credit cash, right? So again, it's summarizing and classifying and collecting that information, and companies then compile financial statements, the income statement, balance sheet, statement of cash flows, and the objective is, right, people are using the information that the company summarize and classify to make decisions. Management uses it to make decisions about their business, where they might need to grow the business or where they might need to cut back, where they're spending too much. Users of that information, such as investors, use information to determine whether or not they want to invest in that company based on their own investment goals and objectives. Lenders might use those financial statements to determine whether or not the company is a good lending risk, right? Do they want a loan? So if they see that a company is having cash flow problems, a lender might not loan money, or they might decide that, yes, we're willing to loan you money, but we're going to charge you a higher interest rate to loan you that because you're a more risky prospect. So the accounting information, right, that's accounting. That information is used to make decisions. Then auditing, however, is determining whether or not that information is recorded properly. So is it recorded in accordance with generally accepted accounting principles? And does it reflect the substance of the transactions, the economic events that the company engaged in? Right? So is it properly recorded, and does it properly reflect the economic events that the company engaged in? Right? And so there's, as we talked about a little while ago, there's a significant amount of judgment involved in this auditing process, right? Because there are obviously transactions that are not black and white. Right? So even transactions that don't involve judgment, right, still presents a level of judgment for the auditor, right? Because the auditor has to, so take something as simple as a sales transaction, right? Sold goods to a customer, the company records revenue, records accounts receivable, and then subsequently records cash. The auditor has to determine when going in, what's the risk here? What do you think the risk might be with a revenue transaction? What would you be concerned about? with revenue? What might you question? Nothing. So if you go out to a client and they says, we recorded revenue, you're like, check. You're okay with it?
Well, whether the transaction actually occurred.
Right. It's not a trick question. Did it occur? Right? Did it really happen? Just because the client said that it happened, the auditor can't, the client represents that we sold these goods. They're making a representation, right? The auditor is not going to accept that. Just because it's on the piece of paper doesn't mean it happened, right? So the auditor has to obtain evidence to determine if that transaction actually happened. And we'll talk about what kinds of evidence and how they go about that when we cover revenue. But that's it. The auditor doesn't know because the client told them. They're starting from this position of the financial statements that shows that the client recorded millions of dollars of revenue. Now they need to determine whether or not millions of dollars of revenue actually occurred. Right? So there's judgment even in basic transactions. So the definition of accounting is that, of auditing, is it's a systematic process of objectively, right? And that's key. Auditors are expected to be objective, which is why a client can't have their internal auditors sign off on an audit report to give to file with the SEC. The auditors are not a part of the management team, right? They're coming in as an objective third party, an independent third party, which we'll talk about the importance of independence when we cover the professional standards, right? Because they're not involved in the processing of the financial statements. They're not involved in the preparation of the financial statements. So objectively obtaining and evaluating evidence, okay, regarding assertions or representations, assertions about that management makes. Management makes these assertions about the economic actions and events that the company engaged in. Right? So those assertions are what we see in the financial statements. The result, they're making assertions about information that's contained in the financial statements, including footnotes. Remember, your footnotes are a part of your financial statements, right? Right? And so auditors, which is why we're auditing the financial statements about economic events to determine whether or not they agree that the assertions that management makes agrees with, right, what's recorded in the financial statements. The assertions and the established criteria, which in this case is GAAP, right? Because we're the U.S., generally accepted accounting principles. If it was an international company doing business in another country, they might report under IFRS, International Financial Reporting Standards. Here in the U.S., we're still using GAAP, right? So those established criteria, and then communicating the results to interested users, right? So the auditor's report, which is the output of the audit process. That one-page report that basically determines or tells the public or users who they're communicating to, the company, they're giving the company a clean opinion with respect if they issue an unqualified opinion. And those interested users are obviously people who rely on the financial statements or financial reports, such as creditors, investors, SEC, PCOB, right? I'm sorry, not PCOB, the SEC, other regulatory bodies. If you're in the financial services area, you have regulations and regulatory bodies that you have to comply with or report to. Okay, so it's a systematic process. The key thing, one of the key characteristics of the audit process of auditors is that they are independent. Right? Auditors have to be independent. Why? What does that mean, to be independent? Yes. What's your name? Elaine.
If they work for the company, they're an independent, separate entity of what the company will be auditing.
Oh, right.
Therefore, you have no connection with the client. And there's no way someone's going to get anything out of giving a good report to the client.
Right. So you said a lot of things there. They don't work for the company, right? They're independent of the clients, and basically they don't have any relationship with the client. They have no incentives, right, to report in the client's favor or report incorrectly. So why is it then that we had Enron and WorldCom and a whole host of auditing failures?
Fraudulent activities, I mean, the auditors was not out, or
The auditors, you said fraudulent activities on the part of the company, and what was your last part?
the auditors, they could have been, given a certain type of incentive to.
Right, so the auditors might have had incentives. What do you think what incentives do you think auditors might have? Do you think the client is paying them off? So you think they're getting kickbacks from the client or a payoff?
I was going to say maybe they have like investments.
Okay, investments, well, they're not supposed to. So when we talk about independence, you can't invest in your client, so you can't own shares in your client. So I heard a lot of yeah when they said, oh yeah, they're paying them off. Okay, how? How do you think they might have been paying them off? In what way? You think they were actually giving them money? Giving them free vacations? But none of that came out, right? None of that was the case with Enron. Yes. And the client won, so they gave in to the client essentially, right? So realistically, a lot of the audit failures, it's certainly with Enron and WorldCom, is not because the client was giving the auditor, the audit partner, money on the side, or giving them monetary, in the sense that monetary gifts, right, or something. Like it's not like they were paying the auditors off to turn the cheek, turn away from the issue. It's a little bit of what Victoria said, right? Was the auditors just kind of gave up, right? The client argued with them and said, this is why it's right, and the auditors no longer challenged the client. They allowed the client to report that way, even though they had doubts about it. And and we'll talk about this a lot more when we talk about independence, that's the difficulty. So when there are audit failures, it's not necessarily because the auditor made a conscious decision to do the wrong thing, right? It's this unconscious bias that they have.
Also, when you do an audit, when you do the testing, you don't go in some of your, I guess in some tests, you don't test everything 100%.
Right.
You only take a few samples. So if you get a few samples and something that was wrong wasn't in your sample, you're not going to know that.
Right, and we'll talk about that. That's a good point, right? Some things you miss just because you don't test 100%, right? And then we'll talk about that's the importance of risk assessment and assessing risk as accurately as possible, because you don't test 100%, right? So you're going to miss things. So that's not a matter of being of independence, right? It's not that you're violating independence. You made a call about your how many items to select and what and then what percentage you were going to look at. So you missed something. That's called sampling risk, right? You just your sample didn't catch everything. But the things that cause auditors, some of the things that are argued that cause auditor to violate their independence is you'll find that there are probably more violations of independence in, where auditors, not because they own stock in their company, not because a spouse works for the client, right? It's not that. it's those judgment issues. It's those incentives that they don't even realize a lot of times that is causing them to bias their decisions, right? So, for example, the way the audit process or the way the audit is set up here in the United States is your client hires you. You're not appointed by a regulatory body. The client hires you. Now, Sarbanes-Oxley tried to address that and try to distance the relationship between management and the auditor to, you know, improve independence, right, by having the audit committee now hire the auditors, right, because the audit committee is supposed to be there on behalf of the shareholders, right, of the company. So they're supposed to protect shareholder interests. They're charged with that. So the Sarbanes-Oxley SEC says, well, let the audit committee hire. Take management out of the hiring process. Because if you take management out of the hiring process, what they're essentially saying is management can hold that as a stick over the, a carrot over the auditor's head, right? So the auditor doesn't, so the auditor has this third party, independent of management, that they now report to. And so if they're having problems, if management is not, if management is, always challenging the auditors or trying to get them to, report more aggressively, the auditors can go to the audit committee and say, look, these are the issues that we found, these are the problems that we see on the audit. Right, so again, that was a way of trying to ensure that, or try to increase audit independence, and by doing that, increasing audit quality. So independence is a huge building block in, in the audit process. So we're going to talk about independence a lot more next week, but I wanted to just introduce that. And is this what we call independence in fact versus independence in appearance? Right? And the standards only cover independence in appearance. And what independence in appearance means is that, and what we have is Rule 101. Rule 101 is the standard that deals with independence. And basically, Rule 101 covers things like can't own stock in your client. Right? Your spouse can't own stock in the client. Your spouse can't be in a significant financial reporting role at the client. So in other words, your spouse can't be the CFO, and you also audit that company, right? Because let's, realistically, how would that work? You're going to challenge your spouse and then go home, right? Might not work out for you. What if you found a significant error or misstatement in the financial statements that your spouse is responsible for preparing, and it could cause them to lose their job? What are you going to do? You lose your job, you lose income, you lose a nice lifestyle, right? So you can't even be put in that position. Standards say, nope, can't do it, right? So that's independent. We'll cover all of the different rules from under 101 next week. But basically, those are the things you can look at and see, right? You can determine if an auditor a firm can check to determine whether or not somebody has stock in a company, right? They can, if you have stock, they can say, nope, you can't audit that client. If their spouse works it, those are things that you could test. It's visible, you can see, right? Independence in fact, basically, you can't monitor, right? Because independence in fact is here. Only the auditor knows if they're truly independent. Only the auditor knows if their decision that they made was unbiased, that they based that decision on the pure facts. Right? So in the example with Enron, where, Enron made a decision, an incorrect decision, on how to account for something. The auditors didn't agree with it. They argued back and forth, but they allowed themselves to be convinced by Enron that it was okay. Were they truly independent in fact? Was it just that they're not good negotiators? They're not, they don't know how to challenge the client? That they're just not great auditors? Is that what it is? Or Is it because there were so many, they were collecting so much in terms of fees, audit fees, consulting fees, and they felt pressure to maintain that client? And because they felt that way, they, kind of like, oh, well, they convinced themselves, they rationalized it was okay. They saw a path to allow Enron to account for those transactions the way that they did. I don't know. Now the regulators came in after the fact and said, look, these are the facts. Millions and millions and millions of dollars in audit fees and consulting fees. Hundreds or significant amount of Andersen personnel now work for Enron. So they can come in after the fact in hindsight, right, and say that there were all of these contributing factors, and because these things existed, the auditors did not challenge Enron. They allowed them to account for these transactions incorrectly. But that's hindsight, right? You don't know that. The auditor didn't say, oh yeah, that's why I did it, right? So that's the problem. That's the challenge with independence in fact. Only the auditor knows what circumstances impacted their decision, right? So you can't regulate independence in fact, right? The standards could, the PCOB, SEC, Sarbanes-Oxley can try to minimize situations or circumstances that would cause the auditor to violate independence in fact, such as having the audit committee hire the auditors. But they can't regulate it 100%. Okay, so we'll talk more about this and the importance next week again of auditors being independent. Some of the major factors, that why we need auditing. Obviously, you as an investor, you can't go in and audit the company's books, right? There's no way the company's going to allow you to come in and audit their books, and until you take this class, you won't be, able. You won't have the skill set to do it, right? But that shouldn't preclude you from investing in a company, right? Also, just the motivations of the person preparing, or the company prepares the financial statements, right? There's a bias. The company's providing that information. So I'm sure we talked about a little bit about earnings management, but also compensation. Compensation for U.S. Executives are talked about quite a bit. Huge numbers, right? Their stock options, bonuses, if you achieve, that are tied to performance, tied to how the company performs, right? So if you are a CFO, and I'm not saying that they do this, but there's an incentive, right? If you want to make a lot of money and your performance, right, your bonus is tied to how well the company does, or tied to whether you achieve company's goals and objectives with respect to earnings per share or net income, then that provides an incentive for you to possibly exploit these judgments in GAAP or subjectivity in GAAP to manage your earnings. So you, as a user of the financial statements or a potential investor, know that exists, right? Which is why we want an independent third party. The other thing is that companies generate a lot of data. There's no way you can actually wrap your mind around the amount of data. So again, you as the investor or somebody who's interested in that company, you don't have access to that information. And if you did have access to that information, you have no way of being able to audit that information or analyze that information. And then also things such as complexity, right? When you talk about companies like financial services companies with derivatives and swaps and all of these really exotic types of transactions that they might engage in, right? That are just hugely complex. It's difficult for the average user to be able to comprehend those transactions or to even be able to determine whether or not to analyze them, to be able to make sense out of them. So again, that's why it's important, just why some of the reasons you want or we expect auditors to be able to provide us with that information, because you as the user of the financial statements, a potential investor, there's information risk for you, right? You don't, because of those reasons I just cited, there's information risk. You don't know the quality or the credibility of the information that management's providing you with, right? And that, and what you want to do is to minimize that information risk, right? And so that's where auditing comes in. The auditor reduces that information risk. So you as a user look to that audit report, that one page in front of the financial statements that basically says the financial statements are prepared in accordance with generally accepted accounting principles. They're free of material misstatements. Right? It provides assurance. There are four different. An audit is a form of assurance service, right? So some of the key words that you look for, key concepts when we talk about assurance, is this idea of independence, integrity, and objectivity, right? You want to know, for that assurance, right, for you to be assured about the information that's contained in those financial statements, you want to know the person was independent, the person is objective, and they have integrity, right? Because the reality is, we could have independent standards, but if the auditor lacks integrity, those standards don't matter, right? It doesn't matter. Objectivity goes out the window, and independence goes out the window. So you want to know that the person has integrity. And when we talk about professional standards, we'll talk about how the professional standards address these areas. Obviously, you want to know that assurance is a professional service. There's some element of judgment involved in that, and we talked about the judgment involved in the financial statements. It improves the quality of the information and the reliability and the relevance of that information, right? So the fact that an auditor performs an audit of financial statements and issues a clean opinion on those financial statements, right, it provides a certain level of quality. That's what we talk about, financial statement quality, right? The information contained in the financial statements is relevant and can be relied on. And obviously, assurance is for people who use that information to make a decision. When we talk about assurance services go beyond just audited financial statements, right? You can make assurance, firms can provide assurances about a number of things, but when we're talking about assurance on financial statements, the person has to be a CPA, certified public accountant. So attestation is just one type of assurance service, which an audit is a type of attestation. So in attestation, there are 5 categories. It's a type of assurance services which is performed by a CPA who issues a report about the reliability. So when you're performing attestation, you're making making attestation or assuring because a third party, such as management, is making, or the provider of that information, I should say, is making assertions about that information. And we'll talk about financial statement assertions in a couple of weeks. There are basically 5 categories of attestation service: the audit of financial statements, attestation of internal controls over financial reporting, review of historical financial statements, attestation services on information technology, and then just other types of attestation services. What we're going to talk about in the course will be number 1 and 2. Attestation regarding the audit of financial statements and attestation of internal controls over financial reporting. This is a good, I'm just going to finish up here and then we'll break. We're going to talk about the Sarbanes-Oxley Act quite a bit, but only as it applies to the auditing firms. One of the major things that Sarbanes-Oxley did was create this attestation of internal control, report on internal controls, right? So a company now, auditors now have to provide an opinion on the internal controls over financial reporting. So when we talk about internal controls and we talk about reporting, we'll talk about the different reports that an auditor can issue. And then just quickly, you know, you have PCAOB. You'll hear me refer to that quite a bit. It's the Public Company Accounting Oversight Board, and basically they regulate the auditors. And you'll see that I'll make distinctions when I'm talking about PCAOB standards, because for the most part, the PCAOB has layered standards on top of auditing standard or standards issued by the AICPA to govern auditing. So we'll talk about that more next week when we talk about standards. So make sure that you read, I'll put up the syllabus, as I said, either later today or tomorrow. So you want to make sure you cover the first chapter and also read the chapter on professional standards with focus on independence. I also posted an article and just read the first few pages about independence. Okay, have a good weekend, everyone.